And we are live. What's going on, guys? It's Ricky. Hope that you guys are all having an amazing. Let me move this. Hope that you guys are all having an amazing Thursday. The rate cut should be in the next few seconds, and we should be able to see how the market's going to react. Market looks incredibly bullish as of right now. We're looking at TQQQ. We have 5 seconds left. Here it goes. It should be a rate cut that is announced. 25 basis points is what is expected. Am I off on the time? No, it's right now, right? Here it goes. Market's dropping. Wait. Quick change of direction. Market going to new highs. New highs on the day for TQQQ. Of course, any and every reason to continue to rally for no reason. Love it. FOMC rate decision came in as expected. Markets are consolidating, not really dropping right now. Here it goes, beginning to show more lack of progress. DJT down 19.72% on the day. Absolutely wild. Hopefully you guys did your part in taking profits. I know a handful of LPP traders are actively shorting DJT. Tesla pumping up to $300 per share, hit $299.74. It looks like it's really itching for that $300 price level, which wouldn't surprise me if it hits it, it takes off, and then just absolutely dumps right after. Because again, there is no fundamental change on Tesla. Tesla stock is exactly the same stock it was 5 days ago when it was trading at $250 per share. So just understand the hype. As long as you respect it, it should respect you. Let's go ahead and see what is reported. Can you guys hear me and see me okay? Is everything okay? Everything good? NASDAQ market pretty much just sideways right now. Good afternoon. Good afternoon. What's up? What's up? What happened to the rate hike? It's a rate cut. Did I put rate hike? No, it's a rate decision. It's a rate cut today. 25 basis points. So from 5% down to 4.75%. Came in as expected. And then the conference is in 27 minutes. Looks like market's already beginning to kind of show signs of a resistance. Still consolidating. The market's been trading sideways for the past, 2 hours, 3 hours? Just trading sideways here, not really progressing on the upside. Stream is good. All right, perfect. I want to see NASDAQ all the way down here at 510. I want to hear what Jerome Powell has to say. I want to hear what he has to say about Trump being back in office, what the Federal Reserve is going to be doing in efforts to prepare for that. Obviously, Trump has a plan when it comes down to tax cuts, when it comes down to tariffs, that should drastically impact inflation. And remember, the Federal Reserve is in charge of inflation and monetary policy. So should be quite interesting to see if he does have a take. Normally, Jerome Powell is very soft-spoken. He doesn't like to get ahead of himself. So again, we just found out pretty much yesterday that Trump is elected. Now, I don't know if that was enough time for them to really have a conversation, if they've created any plan of action to help assist with the tax cuts and the rate and the tariffs. All right. What else are you guys trading today? SMCI still ripping up. It saw a little bit of a pullback, but on the 5-minute, this thing looks unstoppable. Higher highs, higher lows. Man, incredible. Same thing with NVIDIA. NVIDIA incredibly bullish, but incredibly overbought, right? NVIDIA at all-time highs at a $3.64 trillion market cap. Holy smokes. Have no fear, a big pullback is coming soon. All right. Still waiting for markets to react. Market is still pretty much trading sideways. All right, still holding on. QQQ still at 512 per share. Ricky, are you staying online for the press conference? That's the goal. All I ask you guys to do is, again, we'll be live streaming when Jerome Powell gets on here. And when he speaks, the market could completely... There's a lot of volatility that's injected into the market when he begins to speak. Not only because, I mean, he kind of has like a speech that he gives within the first 2 to 3 minutes. It's almost a script that he reads off almost every single time. So if you've tuned on in, you know exactly what I'm talking about. But then after that, there's a bunch of reporters there. And reporters should have some pretty juicy questions based off of, you know, what just happened with the election, what just happened with the recent job report. And I think today should be a good one. I really do, right? There's different factors and different variables that can kind of be talked about or asked about. It doesn't mean Jerome Powell has to comment on it. I really don't think he will. Jerome Powell's very, very good with like staying in his lane. He doesn't normally like to talk about anything outside of what the Federal Reserve shouldn't be talking about. So it's respectful. What was the decision? So the decision was an interest rate cut of 25 basis points. So remember, you guys can always get access to every economic report. If you guys go to techbudsolutions.com under trading tools, we provide it for you for free. Obviously, it's just the calendar and it's a daily calendar. You can look at what reports were yesterday. You can look at what reports were offered today and also what's expected for tomorrow. Within this, you could also get access to our risk calculator, all that good stuff. The trade tracker, all of that's there for you. The trade tracker, I believe, is actually the first link in the description. I'm sorry, not the trade. Yeah, the politician trade tracker. That's actually some pretty good news. I don't know if you guys heard that, but Nancy Pelosi also got reelected. So we have another year of great trades to track. If you guys ever want to subscribe to our free politician trade tracker, we send out one email every single Monday, and it's the first link in the description of this video. So it's absolutely for free. We just send you a nice little picture of the different politicians and the trades that they took. Did they buy? Did they sell? And what did they buy and sell? So very easy to read. Jerome is a ninja in evading questions like Kamala. No, I mean, it's not Jerome Jerome Powell's job to answer questions outside of the Federal Reserve. So people like to ask for his personal opinion. It's not his job to give his personal opinion. He is the head of the Federal Reserve, the central bank of the United States. And I respect it. They like to get anything or more out of him to try to get his own perspective, and he respects his position. Some people might like that. Some people might view it as boring. They want more, but he knows that what he says is very influential to the overall market. So he respects by not giving too much. Biden definitely voted for Trump, for sure. Does a rate cut mean that stocks will go down? Nope. Remember, it's not about going up or down. It's based off of what the market wants or expects versus what is reported. Exactly what was expected, what was reported. So it shouldn't be an overreaction. If the market expected a rate cut and then the Federal Reserve didn't do anything, the markets would then probably drop because that was a surprise, right? But if it comes in normally as expected, normally it shouldn't be any overreaction or anything like that. Do you trade on Webull outside of the US? Yep, there's no restrictions to the times I've used it. So yeah, if you guys want to download Webull, it's the trading application that I use. It's regulated in the US. It's based out of the US, and it's FDIC insured. It's the 5th link in the description of this video. You can refresh this live stream and click the 5th link down below and download it. You don't have to get rid of your old brokerage. You can just try it out. If you use my link, you'll earn up to 40 free shares or something like that. And if you like it, then you can transfer, right? If you don't like it, then you can just close the account. It doesn't cost you anything. Waiting for markets to drop. SMCI, still consolidating, still testing. Dude, everything is just holding on, just lingering at extreme overbought levels. That is wild. Just everything. No business being up here. Can you tell that I want the market to pull on back? I just want, yeah. I was gonna make a joke right now. I just want Tesla to sell off to $100 per share so I could buy it. Yeah, so incredibly bullish. 5-minute time frame gives you a really good perspective on these stocks. Yes, they're overbought, but they're bullish. No reason to fight the trend, right? My position in hood is still open. Yeah, I'm up a little bit more on my hood short right now. So no one is selling Tesla for $100. It's just a joke, brother. You don't have to get offended. Do you have a position in SoFi? I do not. Tesla to 1,000. Yeah.
Still alive?
Yeah. Why?
Why?
We're just waiting. There's 15 minutes left just to even start it, really. You hungry?
Food.
Damn, you're doing meal preps? I'm starving, bro.
No, I got my group from you.
Stop.
Guess why? Guess who's president of LA? I actually do have meal prep. Longevity's got me on this crazy
Yeah.
health kick.
Alright.
Yeah, I saw people saying through the trading related, people having claims that the crypto markets were predicting the election. I think it was the morning of the election.
pumping up.
Yeah.
They're forecasting. Yeah. You have to understand market, like,
Trump's in favor of crypto.
it's not that Trump is in favor of crypto. What I've understood is like he spoke at an event to like, and the thing that I've understood about Bitcoin or any type of cryptocurrency, when anyone of authority talks about it, it acts as like a form of authority and credibility, right?
Yeah.
So by having the president of the United States, technically one of the most powerful positions,
Yeah.
then
Yeah.
you know, it's a good position to be in versus maybe the other side wasn't so pro crypto,
Yeah.
right? So
Yeah.
that might have maybe negatively impacted it. So, but yeah, Bitcoin was definitely pushing up. Anytime that you actually saw a correlation, you know, that app that I used to like bet on Trump, that was going up, and at the same time that was going up, crypto was going up. So it's just looking at projections.
Yeah.
But so was NASDAQ. NASDAQ futures were going up. People just don't pay attention. The crypto's more trendy. So.
Yeah.
Ricky put us on hold. Can you guys hear me okay? This is not my music. This is from the Federal Reserve.
I thought you put it too.
Yeah,
Like
people are like, people.
elevator music?
Literally is what people are commenting. Ricky put us on elevator music. If I put you guys on any music, you know I'm gonna put on Young Dolph. Just kidding. The Fed is trying to calm us down with the music. Ricky, what are your thoughts on PLTR? Good time to short. We talked about it today in our live trading session with the LPP team. On the 30-minute time frame, I think it's very easy to see this like ascending channel, right? There is no break of pattern yet. It's still holding above that $53 price point. Now, if this thing begins to really curl on over and sell off, it's not about indicators. It's not about what I think. It's about price action. Therefore, now there's going to be more selling pressure than there would be buying pressure, and it has a huge gap down to fill. At that point, I could justify maybe entering a light swing trade. But again, those are just my thoughts. You can let me know what you think. So I have my alert set. It was a stock that I was paying attention to, but as long as it stays and remains bullish, there is no reason to enter that short. Make sense? Is that pretty clear? Do you think that gold is heading to 3K, or is that bluff? Gold normally goes up when there's uncertainty in our market or our economy, right? It's like the golden standard, although it's not necessarily something that backs us anymore. It's just the way that the markets flow. Is that where I think it's going? I don't know. Right now, markets look incredibly strong and resilient, right? And as long as that happens, I wouldn't expect that to be good for gold. But if markets do begin to curl on over, or if that's what you think, then yeah, you can try to hedge that by entering gold now if you can tolerate the time that it might take for markets to sell off, an expectation or preparation of markets to sell off, and then gold should technically go up. But then that would be you hoping that markets sell off and that gold then rallies. Ricky, thoughts on leverage ETFs? I think leverage ETFs I personally like trading them. I don't think they're positions that you should hold over a long period of time. We talk about it in the LPP lesson library, where it breaks down the importance of understanding path dependencies, the rate of decay for these leverage ETFs. If you don't understand that, I really don't think you should be holding a leverage ETF for more than just a day. So they're not considered investment vehicles. Will DJT go back to $100? Let me check my crystal ball real quick. I don't know. I would have expected that if there would have been any day that DJT would have pumped, it would have been now, right? As he would have won the presidential race. We all knew that it was a pump and dump. So that is why during our live session with LPP, the morning of yesterday, I took profits right away on DJT. I did it within my live stream. I wanted to express like it looked weak. It was stagnant. We can pull it up real quick. But DJT looked weak during yesterday's pre-market session. So if you actually look at it, let's click on the 5-minute real quick. If you actually look at the progress that was being made pre-market, there's a huge gap up, and then we began trading sideways. I don't want to hold any stock that is this overbought when it's trading sideways anymore. Just like it pumps, it will dump. And I'm so glad. I actually took profits right around 44 to 45. And then all of a sudden it begins to dump. I was already out. I took profits on my long position. I didn't even make that much because I made like 2,000 or 3,000 the day before, but then I took profits. Then I carried 250 shares overnight. I bought at like 39.21, and then I took profits at $44 or $45. I was up about 2K net, I think, but that's it. It wasn't like a crazy home run. I didn't sell at $54. It just, I paid attention to the progress and the price action, and progress was lacking. You could see that it was lagging. It was beginning to curl on over. I wanted to respect that. It's not about my feelings. It's not about my beliefs. It's about what the charts were telling me. That was a very easy trade to get out of. And man, I should have shorted the shit out of it because it sold off 20% today and ended up selling even more yesterday, right? From overall highs to lows, another 18%. So it was a very 40% sell off so far. Just working with the market, right? When you get burned enough by the market, you understand that it's like, it's not about the what if it does skyrocket. It's just like, take your money and bounce. This is why we talk about it to our LPP group. A lot of people that watch our YouTube videos are like, Ricky, why are you always talking about downside risk? Why are you always talking about, well, what if it sells off? Because when you get burned enough by the market, you always taking risk into consideration. And that's my job, right? While everyone just talks about all of the good, I like to take into consideration some of the bad for our beginners that are just getting started, so they're not sold that, hey, this thing just has to continue to skyrocket. Nothing has to continue to rally. And the feedback that I get from our LPP members is always they appreciate that. Woo! Excuse me. Jerome Powell speaks in 9 minutes. Jesse, if that's the case, I want you to send me a direct message right now on Instagram. That is wild. Send me a direct message right now. Send me your order number for TechBuds, and we'll figure it out, okay? I was actually, for all those that were ordering some of our new wall art from Shop TechBuds, I was actually just at the shop that makes it all. It's all printed and made here in the US, in Arizona. And dude, it looks dope. We have a few new Trump designs. I get it. If you guys don't like Trump, I respect that. I can see why. But for those that do, we have this for Shop TechBuds. We have 3 new designs that if you want to be motivated for the next 4 years, it all starts with a dream against all odds, and success is the best revenge. This is one of my favorites. We actually had someone purchase all 3, and they're going to be setting it up at their office, which I think, again, these are not canvas. They're brushed aluminum. It's 23.5 inches by 15.7, something like that. So they're pretty big wall arts. And again, they're very durable. It's brushed aluminum, and it comes with the hardware to push it off. But if you don't like those 3 and you want, again, more traditional, motivational type of art, we have 150 designs you guys can choose from shoptechbuds.com. It's the 4th link in the description down below. We have day trader hoodies, Wall Street hoodies, Porsche hoodies, starting at $30. Again, it's winter. We're trying to offer it at the lowest price, $30. And again, we take care of you. You can buy 1 hoodie, you can buy 5, a bunch of vintage, oversized tees you guys can pick out, a bunch of trading mouse pads. We have t-shirts even for just $20. Again, if you've ever looked or wanted some apparel, some mouse pads, or some wall art to fuel your motivation, shoptechbuds.com, 4th link in the description down below. You guys can use promo code NEW20 and it will get you 20% off your first order. So 7 minutes left, 7 minutes until Jerome Powell speaks. Jesse, do you have me on Discord? I like that. Javier saying Ricky loves shorting overvalued BS AI companies. There's only one, right? SMCI. Yes. All right, Jesse, DM me right now on Discord, and then your order number, and after this live stream, I'll get right back to you, okay? Ricky, can you do a technical analysis on gold? No. I'm on Webull. We don't have gold here. So I shared my thoughts with you about gold. I don't trade gold. It's not something that I'm very well versed with. I'm just explaining to you what I understand. Gold tends to go up when there's uncertainty on the dollar, and dollar goes down. I would assume that the dollar has gone up as Trump has been elected the winner of this presidential race, right? So understanding that correlation is just important to know. Other than that, please do your own due diligence, right? Those are just my thoughts. It's not that it has to react that way. Market's incredibly overbought. Market's incredibly bullish. It looks strong. It looks resilient. If it's an overreaction, it could correct, and then maybe gold can possibly go up. But again, it's still just a what if. We do not know. So that's the risk. This is why we talk about don't put yourself in a position in which you cannot tolerate. How many of you guys actually plan out your trades? This is why we created the little risk calculator. Do you understand your risk to reward ratio? Do you understand your exposure to potential loss, your potential for profit? Like, these are all things you need to understand to really ask yourself, is this trade worth it? I mean, I can show it with you, break it. What do we have? 5 minutes. We have 5 minutes. So on this 30-minute time frame, very quickly, this is an open short position. So from the current price level, we actually got in at 29.80, so it's more up here. I plan to sell right around $25 per share. So I can plug it in real quick, and this is for my hood short. Super simple. I mean, literally takes 1 minute to plan out your trade. So I plan to get in at 29.85, right? That's my average purchase price right now. I plan to cover my short so I make money as it sells off right around $25. That's my plan. I plan to cut losses if it ends up making new highs, which is roughly right around, $30.50. So that would give me a risk to reward ratio of 7.46, which means that I would go in probably with 8,000 shares, which is about $230,000, $240,000. So realistically, I would go closer to $250,000. So let's do 8,400. So 8,400, I could potentially make $40,000. I could potentially lose 5,400. So to me, when I see that, I love that, right? I love the risk to reward ratio. It works with my success rate. I can tolerate this position size because of what I know of myself. And then looking at the potential for profit, best case scenario, potential for loss, worst case scenario, as long as I stick to my trade plan, I like the edge that I have here. I like it. I see it. I see this figure of how much I could potentially lose. So therefore, now there should be no surprises. As long as I manage my risk and as long as I take profits when I say that I'm going to, there should be no surprises. Now, again, if you don't manage your risk, then again, that loss can be more. If you don't take profits or it just doesn't go according to plan, then that doesn't have to be your potential for profit. But before you actually take the trade, it is so important to just break it down so you understand exactly what you are opening yourself to. Not just best case, but also worst case. And then you ask yourself, is it a trade worth taking? Is it worth your time? Is it worth the risk? And that's exactly what that should tell you. So where can we get this risk to reward ratio calculator? We have it for you on our site. It's free to download. We send it to you. If you're part of LPP, we have it for you in our Discord. So if you're part of LPP 3.0, we have it for you in the links section. Okay? If you need it, just send me a direct message on Discord. Again, all I ask you to do is subscribe to our channel. It's free. Drop a thumbs up on this live stream. It's free. And if you're part of our Discord, just message me there. Appreciate you guys. What's with the background music? Dude, it's from the Federal Reserve. We're waiting to go live. You guys are just trolling me today. I'm gonna tell Jerome Powell next time that, hey, Jerome, I was getting roasted on my live stream on YouTube because of your elevator music. Next time, I want you to play 2 Chainz. Is that better? I like it. Let me post that we are live right now. Do you guys want to say what's up to Instagram? Ready? All right, here we go. You want to say what's up? Just cracked me up. There it goes. All right. I'm going to turn it up, okay?
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has eased substantially from a peak of 7% to 2.1% as of September. We are committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the FOMC decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a 1/4 percentage point. We continue to be confident that with an appropriate recalibration of our policy stance, strength in the economy and the labor market can be maintained, with inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In the labor market, conditions remain solid.
Market's going up.
Payroll job gains have slowed from earlier in the year, averaging 104,000 per month over the past 3 months. This figure would have been somewhat higher were it not for the effects of labor strikes and hurricanes on employment in October.
Okay.
Regarding the hurricanes, let me extend our sympathies to all the families, businesses, and communities who have been harmed by these devastating storms. The unemployment rate is notably higher than it was a year ago, but it has edged down over the past 3 months and remains low at 4.1% in October. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years. Total PCE prices rose 2.1% over the 12 months ending in September, excluding the volatile food and energy categories. Core PCE prices rose 2.7%. Overall, inflation has moved much closer to our 2% longer run goal, but core inflation remains somewhat elevated. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we're attentive to the risks to both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4.5% to 4.75%. This further recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we move toward a more neutral stance over time. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing policy restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. We are not on any preset course. We will continue to make our decisions meeting by meeting.
There we go. That's his speech.
As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation is not sustainably moving toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can move more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored.
So bullish.
Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Here we go.
Thank you. Given the expectation that the election outcome will produce policies that would meaningfully impact the U.S. economy next year, how is the committee taking these proposals into account for upcoming decisions, including potentially the next one in December? And can you give us any more sense of how proactive or reactive the Fed is prepared to be to changes in economic policies with the next administration?
Sure. So let me say that in the near term, the election will have no effects on our policy decisions. As you know, many things affect the economy, and anyone who writes down forecasts in their job will tell you that the economy is quite difficult to forecast looking out past the very near term. Here, we don't know what the timing and substance of any policy changes will be. We therefore don't know what the effects on the economy would be, specifically whether and to what extent those policies would matter for the achievement of our goal variables, maximum employment and price stability. We don't guess, we don't speculate, and we don't assume. Now, just in principle, it's possible that any administration's policies or policies put in place by Congress could have economic effects that over time that would matter for our pursuit of our dual mandate goals. So we, along with countless other factors, forecasts of those economic effects would be included in our models of the economy and would be taken into account through that channel.
Nick.
Chair Powell, Nick Timrose from the Wall Street Journal. Roughly 1 year ago, when the 10-year Treasury was flirting with 5% and 30-year mortgage rates were near 8%, you noted how higher borrowing costs, if they were sustained, could weigh on economic activity. Given that you've said you believe policy is restrictive and the Fed is now dialing back that restriction, are the growth risks presented by higher U.S. Treasury yields today any different from those you identified 1 year ago when inflation was still meaningfully above your target?
So I would just say this: we've watched the run up in bond rates, and it's nowhere near where it was, of course, a year ago. I guess the long run rates are well below that level. So we're watching that. Things have been moving around, and we'll see where they settle. I think it's too early to really say where they settle. ultimately, I'm sure we've all read these decompositions of what, and I certainly have, but it's not really our job to provide our specific decomposition. I will say, though, that it appears that the moves are not principally about higher inflation expectations. They're really about a sense of more likelihood of stronger growth and perhaps less in the way of downside risks. So that's what they're about. We do take financial conditions into account if they're persistent and if they're material. Then we'll certainly take them into account in our policy. But I would say we're not at that stage right now. It's just something that we're watching. And again, these things don't really have mainly to do with Fed policy, but to do with other factors in the economy.
Big drop.
If I could follow up.
Big drop.
Is the September SEP, are those rate projections still valid? Do they still seem relevant given where we are now?
It's you get halfway through the cycle between the last set and the next set. I wouldn't want to comment one way or the other. Let's talk about the data we've gotten since the last meeting. So, in the main, the economic activity data have been stronger than expected. The NIPA revision was stronger. Certainly, the September employment report was stronger. The October report not stronger. Retail sales stronger. So overall, though, I think you take away a sense of some of the downside risks to economic activity having been diminished.
Here we go.
With the NIPA revisions in particular. And so overall feeling good about economic activity. So I think we would factor that in. At the same time, we got one inflation report, which it wasn't terrible, but it was a little higher than expected. So I think really the question is December, and by December we'll have more data.
Testing support.
I guess one more employment report, two more
pattern.
inflation reports, and lots of other data, and we'll make a decision as we get to December.
We haven't broken all day.
Gina Smilik from the New York Times. Thanks for taking our questions, Chair Powell. When it comes to December, what will you be looking at specifically as you try to make that decision? And then as of the Fed's economic projections in September, you had written down 4 quarter-point interest rate cuts in 2025. Do you still think that those are likely? Is that sort of the baseline outlook at this point, or has that shifted? And if it shifted at all, can you give a little bit of detail as to why?
I can't. We don't fill out an SEP, and I can't characterize one that wasn't filled out today. So I can't really speak for kind of exactly where the committee is. I will just say for December we're going to be, again, at every meeting we're going to be looking at the incoming data and how that affects the outlook. As you know, we're in the process of recalibrating from a fairly restrictive level at 5.33%. After today's move, we're down 75 basis points. And we're asking ourselves, is that where we need to be? That we're trying to steer between the risk of moving too quickly and perhaps undermining our progress on inflation, or moving too slowly and allowing the labor market to weaken too much. We're trying to be on a middle path where we can maintain the strength in the labor market while also enabling further progress on inflation. We think that's where we are, but that's the question we're going to be asking in September. And in other meetings. And again, I can't really update you on the committee's thinking because we don't fill out an SEP at this meeting.
Yeah, totally appreciate that. I guess when it comes to your own thinking, do you think that a full percentage point of rate cuts in 2025 is a reasonable outlook?
Again, we're going to wait and see how things come in December. I mean, it's just, I would put it this way. We're on a path to a more neutral stance. And that's very much what we're on. That has not changed at all since September. We're just going to have to see where the data lead us. We have, a whole 6 weeks of data to look at to make that decision in December. Obviously, I'm not ruling it out or in, but I would say, I would say that, again, we didn't update the SEP, so I'm not going to characterize, where the committee would be.
Howard.
Thanks, Howard Schneider with Reuters. I wondered if you could please elaborate and explain a little bit the 2 changes in the language of the statement here. In the first paragraph, when you say inflation has made progress, dropping the word further progress. And in the second paragraph, dropping the sentence that the committee had gained greater confidence that inflation was progressing towards its 2% goal. Is there any policy substance behind either of those changes in language? Is it meant to open the door to a December pause? Is it meant to communicate anything about the stickiness of core inflation the last 3 months?
Not really, no. So let me tell you what we were thinking. So the test of gaining further confidence was our test for the first rate cut, right? And so we met that test in September, and therefore we take that test out. If you leave it in, then it's new forward guidance. It's brand new forward guidance. What do you mean by it? Are you requiring yet further? We have to say yes or no at every meeting whether we've made further progress. The point is we have gained confidence that we're on a sustainable path down to 2%. So that I would tell you is what that's really all about. It's not meant to send a signal. Neither of those is meant to send a further signal. And saying further progress, it becomes a test. We don't want to be. We don't think it's a good time to be doing a lot of forward guidance. There's a fair amount of uncertainty in what I've said. The path that we're on, we do know where the destination is, but we don't know the right pace, and we don't know exactly where the destination is. So the point is to find the right pace and the right destination as we go. And I think there's a fair amount of uncertainty about that. And you don't want to tie yourself up with guidance. You want to be able to make sensible decisions as you go.
Steve Leisman, CNBC. Mr. Chairman, you talked about higher rates, perhaps from an expectation of higher growth. You didn't talk about it in terms of expectations of higher deficits. Is that something you think might be behind the recent rise in interest rates? And are rising deficits a concern to you?
So we don't comment on fiscal policy. And again, I don't have a lot more to say on what's driving bond yields. In terms of policy changes, though, let me give you a sense of how this works in the ordinary case. Let's say Congress is considering a rewrite of the tax laws. Doesn't matter what's in the content. So we would follow that. At a certain point, we'd think we see the outlines, so we'd start to model it. And then we'd wait, and then at a certain point, the staff would brief the FOMC and say, these are the likely effects. There's lots and lots of literature on the effects of tax policy changes on various parts of the economy. So we'd try to get smart on that, and then the law actually passes. And you'd start to put it. You probably run an alternative simulation before that happens, just to keep people trying to understand it. Then when it actually passes, it goes into the model, along with a million other things. So, we have a very large economy. Many things are affecting it at any given time, and a law change of some kind would go in there, but it would go in. But it would, it's a process that takes some time. Clearly, the legislative process takes a lot of time, and of course, the real question is not the effect of that law. It's all of the policy changes that are happening. What's the net effect? And the overall effect on the economy at any given time. So I think that's a process that takes a lot of time and that we go through all the time with every administration, constantly. And this will be no different. But right now there's nothing to model right now. It's such an early stage. We don't know what the policies are, and once we know what they are, we won't have a sense of when they'll be implemented or all those sorts of things. So I think I would just say we're not doing that now, and all that will take time, and it will be very much regular order when we do that.
If I could just follow up on Nick's question, are the current rates something you feel like you need to lean against in that they go against the direction of policy by adding restriction to the economy, or do you just take them as a given and perhaps a signal that you should do less?
I just think the first question is how long will they be sustained? If you remember the 5% 10-year, people were drawing massively important conclusions only to find, 3 weeks later the 10-year was 50 basis points lower. So, it's material changes in financial conditions that last, that are persistent, that really matter. And we don't know that about these. What we've seen so far, we're watching it, we're reading, we're doing the decompositions and reading others, but right now it's not a major factor in how we're thinking about things.
Chris.
Thank you, Chris Rugaber at Associated Press. You mentioned the positive economic data that we've seen since the September meeting, including the revisions to things like savings, higher GDP growth. We saw stock market jump yesterday. That's renewed some of the questions about why do many cuts at all in this with this backdrop.
So you're right. As I mentioned, and as you mentioned, the latest economic data have been strong, and that's, of course, a great thing and highly welcome. But, of course, our mandate is maximum employment and price stability, and we think that even with today's cut, policy is still restrictive. We understand it's not possible to say precisely how restrictive, but we feel that it is still restrictive. And if you look at our goal variables, the labor market has cooled a great deal from its overheated state of 2 years ago and is now essentially in balance. It is continuing to cool, albeit at a modest rate. And we don't need further cooling, we don't think, to achieve our inflation mandate. So that's the labor market. Right. Inflation has moved down a great deal from its highs of 2 years ago, and we judged, as I mentioned, that it's on a sustainable path back to 2%. So the job's not done on inflation. But if you look at those two things, we judged in September that it was appropriate to begin to recalibrate our policy stance to reflect this progress, and today's decision is really another step in that process. Overall, as I mentioned, we believe that with an appropriate recalibration of our policy stance, we can maintain strength in the labor market even as our policy stance enables further progress toward our inflation goal.
Great. And just to follow up, what might cause you to pause rate cuts in December? What kind of economic data would lead you to that path? Thank you.
So we haven't made any decision like that at all. But we're in the process, as I mentioned, of moving policy down, our stance down over time to more neutral level. And as a general matter, as we move ahead, we are prepared to adjust our assessments of the appropriate pace and destination as the outlook evolves. So, for example, if we were to see the labor market deteriorating, we'd be prepared to move more quickly. Alternatively, as we approach levels that are plausibly neutral, or close to neutral, it may turn out to be appropriate to slow the pace at which we're dialing back restriction. Again, haven't made any decisions about that, but that's certainly a possibility. If you can think of it as similar to what we do with asset purchase, with asset runoff, with QT. So we reach a point where we slow the pace, much like an airplane reaching the airport slows down. And so we're thinking about it that way, but it's something that we're just beginning to think about.
Edward.
Thanks, Chair Powell. So with the noise in the jobs reports that we've seen, and you look at the Fed's favorite inflation, PCE inflation, overall it's 2.1%, very close to the Fed's target, but core inflation is 2.7%, and it's been that way since July. So why doesn't this data give fuel to a rate pause for this meeting?
Well, so I think if you look at the 3 and 6 month, you're quoting the 12-month. So we look at all of them, right? But if you look at 3 and 6 month core PCE, you'll see they're around 2.3%. So we look at all of them, and we look at 12 as well. But what it's telling us is that we really have made significant progress, and we expect there to be bumps. For example, the last 3 months of last year, the core PCE readings were very, very low, probably unsustainably low. So that's why forecasts generally see a couple of upticks toward the end of the year. On the other hand, the January reading certainly looks like an example of residual seasonality, so that we saw last year. So when that falls out of the 12-month calculation in February, we should see a thing down. So it'll literally be a bump up and then down. We understand that. Overall, you see the progress on inflation, and you also look at the economy and you say, what is the inflation story now? Where's it coming from? So I point to a couple of things. One is the non-housing services and goods, which together make up 80% of the core PCE index, are back to the levels they were at the last time we had sustained 2% inflation, which happens to be in the early 2000s for a period of 5, 6, 7 years. So they're back to that level. What's not is housing services. So let's talk about housing services. Housing services is higher. What's going on there is, market rents, newly signed leases are experiencing very low inflation. And what's happening is older, leases that are turning over are taking several years to catch up to where market rent leases are. So that's just a catch-up problem. It's not really reflecting current inflationary pressures. It's reflecting past inflationary pressures. So that's one thing. The other thing is, I'd say look at the labor market, not a source of inflationary pressures. Where's it coming from? It's not a very tight economy. What is the story about inflation? You see that catch-up inflation also in insurance and several other areas. So you're seeing, we're not declaring victory, obviously, but we feel like the story is very consistent with inflation continuing to come down on a bumpy path over the next couple of years and settling around 2%. That story is intact, and it won't be one or two really good data months or bad data months aren't going to really change the pattern at this point now that we're this far into the process.
So you're quickly trying to get to that neutral rate that you see, or do you foresee that you have some time to get there?
Nothing in the economic data suggests that the committee has any need to be in a hurry to get there. We are seeing strong economic activity. We are seeing ongoing strength in the labor market. We're watching that carefully, but we do see maintaining strength there. And so we think that the right way to find neutral, if you will, is carefully, patiently. Again, that's not meant to have a specific meaning, other than to the extent the economy remains strong, we have the ability to take advantage of that as we try to navigate that middle path between the two risks.
Craig.
Hi, Chair Powell. Craig Torres from Bloomberg. Two questions today. Did you learn anything about what Americans think about the economy from the election results? First question. Second question. I want to talk about some labor market indicators, and I do so with great respect for your attentiveness to the maximum employment side of the mandate, Chair Powell. So the unemployment rate has been at 4% or higher for 6 months. One of the broadest measures of unemployment is up about 0.5 point from a year ago. Compensation gains are sliding back. The quits rate, a signal of labor market dynamism, has been heading down to that bad neighborhood of the 20 teens. So you have put a marker at Jackson Hole saying any further cooling is unwelcome. It is cooling generally a little bit further. So at what point do we reach what you would describe as a shortfall from maximum employment? Thank you.
Sure. So on your first question, I'm not going to talk about anything that relates directly or indirectly to the election. On the second one, this is the great question, and it's the one we think about all the time. So I'll just say a couple things. There's nothing really surprising here. What we know is that the unemployment rate is low. We also know that it's moved up significantly from a year or so ago. So we've seen a big change upward in unemployment. Sometimes that has meant bad things. So far, it doesn't appear to be. It appears that I wouldn't say that the labor market has fully stabilized, because I do think it's continuing to very gradually cool. But it seems to be in a good place, and our policy, of course, is designed to keep it in that good place, to maintain the strength in the labor market, while also enabling further progress on inflation. You mentioned a bunch of indicators, and you're right. The openings to unemployment rate is back to a normal level. I would characterize it more broadly as normalizing. You mentioned wages. Wages are still running just a bit above where they would need to be consistent with 2% inflation, unless productivity is going to remain at this high level. If we see productivity, more sustainably at these high levels, then that would sustain higher wage gains. So I would say, in fact, you can say it the other way, that wage increases are now consistent with 2% inflation, given current productivity readings. But of course, the lore on productivity readings is whenever you see high readings, you should assume they're going to revert pretty quickly to the longer-term trend. That has always been the case for 50 years. But it may be that we're now 5 years. If you look at the NIPA revisions that came out a month ago, we're 5 years into a nice set of productivity readings, which are sustained and very healthy. But overall, it's a good labor market. We could talk about 20 different data series. We'll be looking at all of them, of course. But we don't want the labor market to soften much from here. We don't think we need that to happen to get inflation back to 2%.
Victoria.
Hi, Victoria Guido with Politico. Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
Mike?
Damn.
Michael McKee from Bloomberg Radio and Television. You talk a lot about what the data are telling you and how you are dependent on the data, but in terms of forward-looking assessments of the economy, what are you hearing from CEOs or other officials around the country? What did you hear today from the regional bank presidents about what companies and consumers think about where the economy is going from here rather than looking backwards? And does that match up with what your forecasts have been and what you think the appropriate policy path should be?
So it's hard to characterize a really interesting set of discussions we had, and of course you'll see them in the minutes in 3 weeks. But I would say this: I think the comments from our Reserve Bank colleagues and from the CEOs that they talk to are pretty constructive on the economy right now. Pretty constructive, feeling that the labor market is back to normal, to the point where it's no longer that much a discussion topic in their worlds, whereas 2 years ago it was all they were talking about. So they feel like the labor market's in balance. People feel good about where the economy is. Demand is obviously pretty strong, and you're seeing 2.8% growth in the third quarter estimated. Maybe the year's 2.5%. This is a strong economy. It's actually remarkable how well the U.S. economy has been performing with strong growth, a strong labor market, inflation coming down. We're really performing better than any of our global peers, and I think that is reflected in what you hear from what I hear people hear from CEOs. I don't get to talk to a lot of CEOs in my job, but I hear what others summarize from those, and of course I hear the Reserve Bank presidents do a lot of that, and it's pretty constructive overall. Now, that's not to say there are areas of caution and things like that, but ultimately, overall, pretty positive.
Well, to follow up the areas of caution, if there were black clouds on the horizon that you identified as something you're watching, what would they be?
I think it's things like clearly geopolitical risks around the world are elevated, and just as clearly they've had relatively little effect on the U.S. economy. Now, that can change through the price of oil or otherwise, but people talk about those as something that's on the horizon all the time. But ultimately, if you look at the U.S. economy, its performance has been very good, and that's what we hear from business people and experts.
All right, maybe it's just me. And if you guys want to continue to watch it, please go ahead. We've been live for at least 1 hour, 30 minutes of him actually talking. Now, is the economy technically doing well? Yes, when it comes down to the stock market. The stock market's at all-time highs. But remember, the stock market's based off of projection. When you really, I think it's super easy to understand. If this was a thriving economy and if everyone was doing so well, it would have been so easy for Biden and Kamala to have been reelected because everyone's winning. But that is just not the case. I don't think it comes down to our inflation numbers because of how inflation is tracked. Inflation only takes the last 12 months into consideration. You cannot tell me that you are paying the same amount at the grocery store than you were 4 years ago. You are paying so much more, not 2.5% more, so much more, right? The inflation rate is skewed based off of the last 12 months because so much has happened in the last 4 years. Now, maybe it's just me, right? But with what also I see on the real estate side of things, we have properties now sitting on market for sale more now than we did a few months ago. I think that there's fear. We do not know where the market's going. Yes, the stock market is at all-time highs. Companies and billion and trillion-dollar companies are thriving in their, I would say, fields. But when I hear that the average person can't find a job, they're not making enough, they can't cover rent, they can't cover groceries, or they're paying so much more to cover all of that, I think that just speaks volume on why it was an absolute sweep for the Republicans versus the Democrats. Because yes, when it comes down to the stats, technically in the way that it's calculated, sure, we do have a thriving stock market. Yes, inflation is technically low, but it's because of how it's calculated. When you ask the average person of how much money they have saved and if they feel like they are in good hands, I think it would be an overwhelming answer that it would simply be no. So I'm actually really surprised that that's the way that, I guess it's just his perspective. He goes based off of the data, and the data does support the case that it is good. I guess we'll actually see. My fear is that the market is at all-time highs, yet everything else kind of feels stagnant. Real estate, business growth, job growth, inflation, it's all kind of just stagnant. It feels like we're waiting for something big to happen. So markets are at all-time highs. Markets are thriving. So there's a lot of money to make for you guys that can go with the market. But when markets are this overbought, this bullish for such a long time, then come these corrections. And I just want to make sure that that is something that we just do not ignore. But as of now, we're above the moving average, we're above EMA, we're showing signs of just being incredibly bullish, but also incredibly overbought. If this hype ends up fading and this momentum begins to slow down, then again, the rubber band effect, just as quick as it runs up, it will quickly correct itself. So you cannot be surprised. We'll talk about this in a little bit more detail. As of right now, it looks like the market's reacting in a pretty positive way, and there's about 55 minutes left until the market closes. For a quick little update on my Robinhood short, I'm up a little bit over $1,800. So not a crazy amount. I plan to reduce my short as we get closer to that $29 price point, especially as we go into the close. I added a little bit more to my short position, and I kept my LPP team up to date. Again, guys, we are running a sell right now. You do not have to join, but if you're an absolute beginner and you want to be able to watch me trade live and you want access to the A to Z video lesson library, right now you can join LPP for $1 a day is what it breaks down to with the sale that we have going on. If you want to learn more about it, it should be the second link in the description down below. If you don't see the discount link, then again, send me a direct message via Instagram or via Discord, and would love to send it to you. I appreciate your time. Hope that earns your thumbs up. Don't forget to join our Politician Trade Tracker. It's the first link in the description down below. And like always, let's make sure that we end the year on a green